Again, warnings, 2000 crash signs are everywhere. How to protect your gains and preserve your capital. And this is short topic. I've been talking about the whole hour about this without getting too boring. Here's a chart. So most of you may have heard this thing called an inverted yield curve. What inverted yield curve means is that short-term rates go above long-term rates, meaning a treasury bill or a 2-year note, in this case, in the yield curve, is looked at if that goes above a 30-year bond rate, which had happened for a while now. Actually, this was the longest period that we had an inverted yield curve. And inverted yield curves are always signs of a recession. Not always, but most of the time, right? So we had a 2-year note that was way above the 30-year bond, inverted yield curve. Okay. The percentages of US yield curves that are inverted is down from 92 to 67, marking the sharpest decrease in 2000 since 2020. In the past, whenever this percentage rose above 70 and subsequently started dropping, the US economy fell into a recession. Here's another warning sign. Look at that chart on the right-hand side. See all these little circles? Those are all the peaks of inverted yield curves. And now we peaked and now we're coming down. Why? Because the Fed cut the rates by 50 basis points and they're going to keep cutting. So inversion has ended, right? So now we're in a neutral or a positive yield curve. But they are doing that for a reason, right? And every time we had a long period of inverted yield curve, we ended up with a recession. On the chart on the left-hand side, these are every going back to, I think this goes to 1980, 44 years. So there's a chart, again, by the Kabesi letter, thumbs up to them. Here's a chart showing every major US recession since 1980. The mid-1990s were the only time that the Fed was able to achieve a soft landing, right? That was that one right there, the one highlighted with a green box around it. So, and you on the bottom, you guys can see the interest rates, right? See that period of flatness, that was ZIRP, zero interest rate policy. And then we raised the rates, and then we went back to zero interest rate policy. We went twice to ZIRP. One was the great financial crisis, which lasted, the ZIRP lasted 15 years. Then we raised the rates. Then we came down, and then during the pandemic, we went to ZIRP again. ZIRP is zero interest rate policy. So when I say these acronyms, I think you all know it, but then I have to remind myself that maybe they don't. And now we're cutting rates again. So that's called the Fed pivot. Do you guys see the interest rates, what's happening there? So when the Fed pivot happens, it happens because we're going in a recession. And 5 out of the last 6 times we've pivoted, Fed could not manage a soft landing. So maybe this time is different. And I'm going to end with that. And this soft landing came at a time in the 90s where there was not a persistent yield curve inversion, where we talk about it. I know this is becoming a little technical, but just indulge me because I love this stuff. So this is what's happening. We had an inverted yield curve for literally like a year and a half, maybe more. Okay. Every time we had that prolonged inverted yield curve, and then we went to a positive yield curve, definitely recession took place.